听见资本本期视频为您带来的是大摩根士丹利在4月3日闭门会关于煤炭和冶金行业的内容。冶金煤市场最近有点让人摸不着头脑，价格一度跌到几年来的低点，主要是因为供过于求，特别是中国那边的需求不太行，连天气因素都没能把价格抬起来，这背后反映了市场的严重失衡。同时，全球贸易格局正在被重塑，各种关税、配额政策还有地缘政治因素都在深刻影响着煤炭到底流向哪里。比如美国和俄罗斯的煤炭现在更多的涌向了亚洲市场，那未来会怎么样？分析师预测下半年市场可能有点起色，主要得看库存消化情况以及印度等地的需求能不能真正回来。但这里面风险可不小，很多矿商，特别是成本较高的美国矿商，正承受着巨大的经营压力，有些甚至已经撑不住申请破产了。如果价格持续低迷，会不会有更多高成本产能被迫退出市场？这对全球钢铁行业供应链稳定以及相关投资又意味着什么？接下来是英文会议的全部内容，会深入剖析这些复杂的市场现状、价格预测和潜在风险，信息量很大。对相关行业的朋友来说，里面的分析和警告值得高度关注。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello all, good afternoon and welcome. I'm Rahul Anand from the Australian Materials team, and I have with me the S&P team today. So we've got both the editor side, which is going to talk about the current spot environment in the met coal market. But then on top of that, we also have participants from the forecasting side, which will help us understand the forecasts. So we have Olivia Zhang with us today, who's the senior editor for metallurgical coal and coke. We also have the managing editor, that's Samuel Chin, in the metallurgical coal and coke department. And then we've got Sylvia with us, who's a senior specialist in the metals analytics side. Just before we begin, a few quick notes. Firstly, this webcast is being recorded and is strictly for Morgan Stanley institutional clients, invited corporates, and others that have been basically accepted into this webcast. If anyone else is dialed in at this point in time, especially members of the press, I do request you to please disconnect now and to reach out to me separately. We'll start today with some brief introductory comments from our speakers. They'll last about 15 minutes. That's a good time for the audience to think about any questions that come up through that presentation. And you can send those through via the Q&A dialog box in the webcast service, and we'll pick them up once the Q&A section of the call commences. Typically, these calls go for about 30 to 45 minutes. However, judging by the interest in the call, we have allowed up to 1 hour for this call to run to. Anything over that will be taken offline. So look, with all that out of the way, thank you very much for joining me, Team S&P. I will go to Olivia first, please, for your introductory comments. Thanks.
Thank you, Rahul. Hi, everyone. I'm Olivia from the Macro and Coke editorial team. Today, I'm going to give you an update on the Asian met coal market, what factors have been driving the prices lately, and how the political and industry policies have shifted the global trade flows. There's a lot to unpack, so let's dive straight in. In Q1 this year, Asian coking coal prices have been under significant pressure. On March 20th, the Australian PLV FOB prices dropped to a more than 3.5-year low at 166 FOB. The primary reason is too much supply and not enough demand. Australian miners kept their production stable. They pushed more coal into the spot market, but demand was weak, especially from China. The blue shades here mark the cyclone seasons in Queensland, Australia, where most of the met coal mines are located. Typically, during the cyclone season, there will be supply disruptions and the prices will normally go up, at least for temporarily. But this Q1, despite the cyclone Alfred and heavy rainfalls impacted the mining and port operations, the prices continue to go down. This indicates that the sustained oversupply kept pressuring price downward. Also, in the last quarter, the policy shifts have played a key role. At the end of last year, India introduced the quota restrictions on met coal imports to protect its domestic coke maker. This policy has hurt the Indonesian cokeries because they rely heavily on Indian buyers. Ironically, this policy didn't help Indian domestic coal producers as well, because this quota restriction only lasts until this June. So many Indian merchant cokeries who already shut down their coke ovens earlier feel it's too risky to restart their operations. There is no clarity on whether India will extend the quota restrictions. And 2 days ago, India launched an anti-dumping investigation into imported coke. Market sources believe the investigation result will be a key factor to watch because that may determine India's policy on imported coke in the future. Meanwhile, the renewed US-China tariff war since March has also changed the trade flows. We will come back to that shortly. Today, the market is also monitoring the impact of the new US tariff announced last night, and they are watching to see if other countries will announce any retaliatory measures. Having said that, with the FOB prices falling to the current levels, we are seeing more resistance to further significant falls in prices, because the Australian FOB prices plus freight are now closer to the levels that China can step in as a buyer and absorb any extra supply. Next slide, please. Thank you. This slide shows the prime coal transactions reported to Platts. So far this year, with Australian miners offloading more supply, spot transactions have increased. The transaction volumes rose 12.5% year-on-year in Q1, reaching 1.25 million tons. These sales were mainly driven by Indian-focused traders who break down large vessels into smaller parcels and sell to small volume Indian end users. In the last quarter, China stayed away from the seaborne prime coal market. They relied mostly on cheaper domestic coal and portside inventories, not only because these coals are cheaper, but also they offer more flexibility to buy in smaller quantities, and therefore the buyers can reduce their exposure to downward price risk. In Southeast Asia, demand also weakened, particularly from Indonesia, because the Indian quota restriction hit the regional coke production hard. Next slide. Thank you. Now let's talk about how global supply patterns are shifting. S&P Global has this commodities as C-service, which we can track the shipments of bulk commodities, including met coal. These listed are the key met coal exporting countries. We can see that the Australian met coal shipments remain quite stable over the past few years, continuing their dominant role in seaborne supply. On the other hand, US met coal exports have been recovering since 2021 after it collapsed during the pandemic period. In 2020, the volume was 68.6 million tons, but by 2024, the number had climbed back to 60.3 million tons, almost returning to 2018 levels. But the key change is that more US coal is heading to Asia. For example, in 2018, only 14 million tons went to Asia, but by 2024, that jumped 62% to 22.6 million tons. US coal export to China also almost doubled over the same period. However, after China imposed the 15% additional tariffs on US coal in this March, more US coal shipments were diverted to other markets such as India, Southeast Asia, and then the JKT region. Russia is also flooding the Asian market with its coal after the sanctions. For example, in 2018, Russia sent just 1.4 million tons met coal to China, but by 2024, that surged to 17.8 million tons. And in 2023, it was even higher at 34.2 million tons. Can we move to the next slides? Then on the demand side, these are the major met coal importers. We can see here, India, Vietnam, and Indonesia continue to see some growth in the past few years, while the GKT and Europe region are facing declines. India's coking coal imports hit 77.3 million tons last year, which was up around 23% from 2020 level, driven by the domestic coke and steel capacity expansion. Indonesian coking coal demand also increased with more coke ovens constructed by Chinese companies commissioned. But now they are running at reduced utilization rate because they lost Indian as a key buyer. However, the JKT region and Europe are reducing coking coal imports largely due to the sluggish demand and also its transition to more eco-friendly steelmaking methods. Especially in the APEC region, local steel producers are facing stiffer competition from Chinese steel, which weighed on their steel production and also reduced their coking coal demand. China exported a record 170 million tons of steel in 2024, which was up 25% year-on-year. This surge was mainly because of weak domestic demand, especially from its struggling property sector. As global steelmakers facing intense pressure from Chinese steel exports, we see growing protectionism with countries like Vietnam, South Korea, Malaysia, and Thailand, etc., all launching trade cases against the Chinese steel. But even China cannot sustain this pace forever, as the domestic steel demand still low and then the global market tightens. Chinese mills may eventually have to cut production, which will ripple through to the coking coal market. That's wrap up on my sharing today. Back to you, Rahul.
Thank you, Olivia. Sylvia, over to you.
Thank you, Rahul. Thank you, Olivia. This is Sylvia from Metals Mining Analytics team. Today, I want to share with you our team's outlook and forecast about met coal. Can we go to next slide? Yeah, on the right, on the left chart, you can see our forecast for the met coal price, and you can see one is the PLV HCC FOB Australia price. Another is the PLV CFR China. And for the first half of this year, we think the prices will be pressured because of the oversupply and weak demand from China, India, and major buyer. And we foresee a potential recovery in the second half of this year due to the destocking and improved construction activities. And also, we forecast that the steel demand from India will be picked up in the second half. So it will also will help the met coal demand. We see China market inventory for the coking coal at a very high level. So far, by the end of March, it increased around 10% compared with last year. And by the end of February, the increase was 20 around. So we think the market is undergoing some destocking. And it will help to support the prices maybe in May or June. And also we pay attention to the production and other costs. Like for China production mining company, their production cost would be around 600 to 1,200 RMB per ton. And for the Mongolia coal, it would be around 900 to 1,200 yuan per ton. So it is very close to the Chinese domestic coal prices recently, and it put pressure to the high-cost mining companies. For the foreign companies like the Australia or the US, we see for the Anglo-American, their coking coal unit cost is $124. And earlier in 2023, it is 121, and it is excluding the royalties fees. And another company like the Coronado, they are taking the efforts to reduce the cost, and meanwhile they want to ramp up the production. And their mining cost in 2023 is around $109. So we think the production costs will, to some extent, to provide a price floor. And we also see some positive signal to the coking coal prices recently. And the Chinese domestic coke market, they are initiating their first round of price jump. We think in 2024, FOB Australia price will be at $181, and CFR will be similar at $182. Next slide, please. Here is some analysis on the U.S. metallurgical coal exports, and on the left pie chart, you can see India, China, Brazil, Netherlands, and Japan. They are accounted for the majority of the U.S. met coal exports destination. And India is the largest buyer. So we think China's 15 tariffs on top of 3 means U.S. need to find other Asian markets. We think it would be largely the India. And for Brazil, it also accounted for a large proportion, like 12%. So we think any tariffs on BRICS nations will have a big impact on U.S. coal exports. And also for the Europe countries like the Netherlands, Germany, France, as we all know that EU countries are moving forward to their decarbonization, and more green steel projects will be coming online. So it will mean they will require less met coal in future. So we think U.S. coal are harder to sell to Asia when Australia prices are lower. And now you can see on the right chart, in recent 3 months, especially this year, FOB Australia and FOB US East Coast prices, they are getting very close, and even are like $5 gap. So we think if US want to compete with Australia price, they need to get more discount, especially on the freight. So recent very frequent US trade conflict with other countries, we think it will have a knock-on effect on Australia coal and set to drive the prices lower. Can we move to the next page? Yeah, thank you. This is 2 charts show the Australia coking coal exports performance. We can see in January it dropped dramatically on Queensland wet weather. And they have major coal terminal like the Abbott Point and Dalrymple Bay. They all witnessed a very big drop in January. And but we don't think it will drive price higher because China and India are very oversupplied. And this year, the weather factor didn't have any impact on the price performance. And in January, we can see the Australia coking coal exports to China and the Netherlands almost halved. So we think maybe in the coming months it will ramp up because we forecast Australia will ship more coking coal to the global market this year. Can we go to the final page? Yeah. This is our metallurgical coal exports and imports forecast. We see not much new supply in the pipeline, but except for the Australia. In 2025 and 2026, we forecast it will increase 3 million or 4 million respectively. For the US and Canada, we think US are struggling with a lot of trade conflict and it will impact on their exports this year. So we give a drop on 2025. For Canada, we don't see much new projects coming online because Canada is moving forward to the decarbonization, and they are have a shift to the renewable energy. So it's a very small drop for them in 2025. And for Russia and Mongolia, they are the major buyer for China and also Russia for India. But we don't think they will have a ramp up to this year, especially for the Russia, because the Russia-Ukraine invasion are still going on. It brings a lot of uncertainty. And Mongolia, they want to establish the cross-border railway with China, and they aims to ship more to China. But now China has very high inventory, so we have a question mark on here. And also Mongolia coal, they need to compete with Australia coal. Australia one, they have better quality, but now with very low price. So Mongolia, if Mongolia can ship more, it is also a question. And for the import side, we see India and the Southeast Asia, they will have some increase in the next 2 years because of their ambitious steel expansion plan. For China, we see it will have a gradual drop in 2025 and 2027 due to now Chinese steel mills, they have very weak margins. And also we forecast the China pig iron production will drop year on year. And for the traditional market, other like Japan, EU, South Korea, we also don't see any ramp up in the coming years. They just have a drop gradually. Yes, that's what I want to share for slides. Thank you for your time. Over to you, Rahul.
Thank you. Thank you, Sylvia. Thank you, Olivia. That ends the introductory comments. I'd now switch into the Q&A section of the call. Just a reminder to the audience, the way to ask a question today is via the Q&A dialog box of your webcast service in front of you, and I'll pick up your questions. We've got a couple of questions in the queue already, team, but there's one thing that I wanted to perhaps start the discussion with, which was stepping into 2025, obviously steel tariffs have become quite topical. And it's not just from the US, it's also from other markets that were importing Chinese steel in 2025. If we think about India, Vietnam, Brazil, other markets also talking about potentially steel tariffs. So have you done any work around that as to how that might impact the met coal flows, or is there any part of the met coal supply chain, seaborne-wise at least, that potentially gets sterilized or impacted, if Chinese exports decline and steel production in other regions domestically picks up? Maybe that's for Sylvia, yeah.
Yeah, maybe I can take this one. We think that currently India's steel market demand is quite flat because of the very low price steel from China and also the weak global steel market. But we think it will grow gradually in second half of this year because India government and steel mills, they are also willing to post their temporary tariff on their low price anti-dumping steel products like from Vietnam and from China. So currently India steel mills, they have very high inventory of 2 to 3 months. So we think like the macro market, they also have very high inventories. They need time to absorb their unsold cargoes and also the inventories. And maybe in second half of this year, they will have some good performance compared with first half. And and the key is whether the India government, they will implement the tax. So if implemented, it will cause some increase in India domestic prices and then bring the pick up of the macro demand. Yeah.
Understood. And do you think some of the met coal that perhaps China is importing, and if that steel production shifts to, let's say, India or somewhere else, can some of those trades be rerouted away from China? So, for instance, Russia. Have you thought about the logistics between maybe Russia and Mongolia, whether they can supply some of that met coal into India if Chinese steel production drops and picks up in other jurisdictions, or does some of that supply just come out of the market because of the trade routes being strained?
Yeah, we think every country, they are diversifying their met coal origin because it is very precious for some countries. Like India, we think they are trying to import some met coal from Mongolia, but transportation is complicated. Like number one option is ship the coal like via China. And the option two is ship the coal via Russia, but Russia would be more expensive. So I think it is also related with some countries, their own preference, and they don't want to rely on their one or two origins. They want to diversify. And China, we can see over January to February this year, their coking coal imports from Mongolia, the share dropped dramatically from 48 in 2024 percentage to like the first 2 months this year to 38. So we think the share is also dropping, like from US and from Australia, their imports are increased a lot. So we think it is changing all the time due to the tariffs and also the policies and every country their strategy.
Got it. Okay. Let's take a question from the webcast service now. So this one's talking about the steel reforms in China. So they haven't specifically mentioned supply side reforms, but I'll assume that's what the question is. How do you think the China steel reforms could impact demand for met coal? What time do you think there will be a preference for higher grade ore? I think this is now iron ore, but which would mean less met coal. Okay. So basically, how do you think about the steel reforms or the supply side reforms that are being talked about in China? Maybe we'll get Olivia in this as well.
Yeah, I can go first. I think the China steel production we forecast this year will drop around 12 million metric ton. So this is on the condition that the government do not publish any mandatory production cut. It's just based on the market condition. And we think when the steel production drop, it will also cause the drop of macro demand. And we heard a lot of rumors in the market that saying this year China will cut like 50 million metric ton. But we think it's too much because China wants to have a stable GDP growth in 2025. And we think it is not that possible to cut so much. Yeah. Olivia, do you want to add anything?
Nothing from me on this one. Thank you.
Okay. Perfect. Okay. I wanted to test your forecast a bit, and there's 2 or 3 questions here in the webcast as well talking about that. I'll see how I can bring them in as well. But it sounds to me quite bearish. I mean, you're talking about high inventories, and you're talking about sluggish demand in general, and steel production as well in your chart didn't seem that great, but you're still expecting a recovery in the second half. I mean, what is driving this recovery? Are you thinking some supply comes out of the market? Is this a cost-based driven recovery? What's driving the price higher in the second half? And I'll maybe pick up some webcast questions after my question to add a bit more detail in there. Thanks.
Yeah, we think so far China has very high inventory and also to the India market. But we think India market will come back in the second half due to maybe some new tariff policy implemented and also inventory destocking. Yeah, and also in the second half, maybe the weather get warmer on China's property or construction market will warming up. And we also observe that in 2024, India, they do not spend all their infrastructure budget, but maybe this part will be put in this year and push up their infrastructure construction and then some ramp up for their demand. And also China, inventory, they are really happening some destocking. Because by the end of March, the inventory increased 10% on year. Compared with by the end of February, the inventory increased 20%. So we think it is, destocking accelerating now.
Got it. Okay, so I guess that comes back to my initial point that you probably expect that, Chinese exports coming down would probably be better for met coal because India will export more met coal and some of that will probably not come into the seaborne market that is going into China. Let me ask you one follow-up question from the India side, which is here in the webcast. So you expect the second half price recovery in met coal, but if we consider the monsoon season and current oversupply situation, what's the risk that the recovery does not come through? Have you heard any met coal mines talking about production cuts because of cost pressures?
Actually, we think for the whole year, for the total whole year 2025, the coking coal prices are under pressure. But the second half prices would be a little bit higher compared with first half, but not much, So you can see a recovery, but it's a very small recovery. And also for the India steel mills, I do not hear any production cut so far. So
So I think the production cut question is more about met coal.
Okay.
I think, which is what I kind of hinted earlier, whether you think any of the met coal supply is going to come out at all, given the cost-based pressures.
I think in China, because Chinese government, they have the coal guarantee policy, because the coal is the energy material for the whole country. So they have their coal supply guarantee. So I think for this year, China coking coal production will keep stable and not have any production cut, even when it is close to the production cost line. The state-owned companies, they are still producing in normal. But for some smaller ones or the private companies, they will cut production. For the India side, I'm not quite sure. Do you have anything about that, Olivia?
I think on this subject regarding the cost basis, we're hearing more of the U.S. mines closure maybe since last year due to the low prices and then the running at losses and then they went to bankruptcy and closed. And also we heard from market sources that maybe some Australian miners with smaller scale and the higher production cost, they are under the pressure to cut production as well. But I don't have any specific data on this one.
Okay, over to Samuel. I see Samuel's gone off mute.
Thanks, Rahul. Yeah, just to add on to Sylvia and Olivia as well. Yes, actually, from the start of the first quarter this year, quite a bit of US coal miners have actually filed for bankruptcy. If I'm not mistaken, COSA, Heritage Coal, Natural Resources. All this is also on the back of very poor, I guess, export numbers that we're seeing in terms of prices. Yes, if technically, if you are a miner and just producing coal itself, compared to, for example, a larger miner that has a bigger basket of products to offer, which could actually help to stomach a little bit of the cost pressures and the loss pressures or the profit and loss per unit. They actually will face a little bit more issues because back in 2023, we did see that US try to push a lot more coals to Asia because Europe is technically not really buying those coals. And back in 2024, numbers have actually skyrocketed to about 22 million to come to Asia. I mean, those that are actually being seaborne shipped to Asia itself. But that said, at the same time, it's also kind of eating into the market here and making prices come back down. They have been giving quite a lot of discounts, of course, at their own cost, $20, $30 per metric ton, just to compete with Australian freight rates, because Australia is nearer to Asia. And because of all those, it's, not only the US has increased volumes to Asia itself, you see Canadian volumes eventually will, with the tariff from the US, will have to flow to Asia itself. It's not a lot, but yeah, it's still additional volumes. You have Mozambique, you have Colombia, you have Russian volumes. India used to buy less than 1 million metric tons of Russian volumes before COVID, 2018, 2019, right? But now we're seeing about 17 mil. So all this is driving up competition and also at the same time putting cost pressures on the miners. So eventually, if prices don't recover, which is of course directly linked to steel prices, steel demand, that could actually put a lot of pressures on more boutique miners, I would say.
And do you have any, if I wanted to perhaps draw out sort of which regions are most at risk in terms of that supply, would I be correct in thinking the Americas would be the ones, given the freight rates, like Colombia and others would be sort of more at risk as opposed to, I guess, the Asian region suppliers?
Risk-wise, yeah, because for US, the natural market will of course be their own domestic markets and maybe Brazil or to Europe. Them shipping to Asia here puts them at a higher cost, of course, for freight. Likewise for Colombia. But that said as well, on the plus side, Asia side is getting used to using their coals compared to 5-10 years ago. People here were afraid of actually trying out the coals. But you see all the diversification of their blends that they want to do, especially in India, especially in China. They've been more comfortable in using the US coals. And even in Southeast Asia, for example, even in Korea, for example, you see Mozambique coals actually going there. So there's a balance there, I would have to say. Yeah. Again, if coal prices are subdued, then yeah, naturally they will face a higher challenge.
Got it. Okay, perfect. Let's take another couple. There's two more in the webcast as far as I can see at the moment. We're nearly at the 45-minute mark, so I'll pick some of these up now. We haven't talked about semi-hard and PCI, so someone's asking about the outlook for these. Sylvia, maybe? Do you want to talk about potential, where you see the discounts on some of the PCI and semi-hard products? How do you think they will trade in this market going forward?
Sorry, we do not have the semi-soft and PCI forecast now. We only have the PRV outlook. So maybe Samuel or Olivia can take this one.
Okay. Any pointers, Samuel or Olivia?
So maybe I can touch upon the PCI part a bit. So comparing with the PLV and LV SCC, we see that the supply and demand for the PCI in the spot market may be a bit more balanced. And like comparing with the oversupply market with the PLV and LVHC market, the PCI, we haven't noticed a lot of spot supply. So most of them are signed on long-term contract basis. And occasionally we hear some buying interest for the PCI. So having said that, I think these prices might be under less downward pressure at the current level comparing with the other grades of coal. Yeah.
That's very interesting and very helpful. Thank you for that. Okay, let's take the next question. This one's for Sylvia. Sylvia, the question is, 2026, you have your supply being flat, but demand is falling in the same period. This is slide 11 of your presentation. Why will this not mean lower prices in 2026 versus 2025?
Sorry, I want to clarify. Yeah, sorry.
Yep. I was going to say maybe you want to share that slide again, but go ahead.
Yeah. I want to clarify here because that is the major countries, imports and the exports countries. So here we do not include like exports country like other exporters and importers. We do not include like the Southern America and also Taiwan. Taiwan is also a big buyer. So it is not complete. It is just to give you a picture of the major buyer and exporter performance.
Understood. Understood. Okay, got it. All right, I've got. I thought we had finished the questions, but there's one more that's come in. Where do you see the new sources of supply into the next couple of years from the met coal market? And is some of this supply being held back because of the current prices? I think it's similar to the slide 11 question, that is there potential that if prices rise that you might get more supply because current prices are not allowing some of that to come online? So I guess maybe from Mongolia or Russia or any other markets that may add more supply.
Yeah, I think besides Australia, they are quite stable for the production ramp up. For the other countries, we do not see that is stable for the forecast. There are a lot of uncertainties, like Mongolia, they need to compete with Australia coal when the price is lower. And also they have the transportation bottleneck. They need to establish the cross-border railway. It will take several years. And for Russia, they have their invention with their Ukraine. So that is a big uncertainty. And also for the Mozambique, we see in the maybe next 10 years, it will be ramp up for the production, but we do not see especially when the price is falling down, because Mozambique, we heard the production costs are very high, maybe above $200 US. And also for Canada, they are falling down. Yeah, they do not invest any big projects domestically. So yeah, we think it is quite thin pipeline for the supply in the future.
Got it. Okay. I was going to close there, but I'll take one last question, which just came through, which is, do you have a view on how much of the met coal market currently is loss-making? I think that's a question perhaps for every one of you. Maybe Samuel and Olivia and Sylvia, if you've got any numbers or any thoughts on that to close. Samuel first, maybe?
Thanks, Rahul. So for us, it's more of hearing what's on the ground from the editorial side of things. We don't have a pie chart to actually show the split to it. But generally, we're hearing that in Australia side of things, the cost of production is around 160 to 190, including royalties and whatnot. So at the current price level of the premium hard coking coal, some of them are indeed producing at a loss. Likewise, for the US, we're hearing it's about 160 to 190 FOB cost-wise. And for them to actually sell to Asia itself, tier 2 grades, for example, the hard coking coals, those are definitely running in the red, I would have to say. Apart from all those, of course, there's cost of financing and whatnot. And that is also the reason why these mills are not seeing a very good Q1, for lack of a colorful description. Yeah, so technically we're around that area there. But of course, if the miners' portfolio is slightly bigger with more different types of commodities, perhaps that could help. I haven't actually had a chance to look at how the other commodities are performing as well, non-ferrous, for example, or even iron ore. But that could actually help to sum up a little bit compared to just pure thermal or pure met coal.
Yes, maybe I can add a little bit on China domestic market, because I heard from the market that some small proportion of China coal miners, they are break even or lost money because of the very low price for the domestically. And I also talked about the production costs, like China miners, they are ranging from 600 to 1,200 yuan per ton. So it has very large range, and it depends on the mine's size, location, and also the technology, many factors to make the costs different. Yeah.
Okay, perfect. Olivia, anything to add?
Yeah, maybe I would just add a little bit on that as well. So as Sam showed, yeah, I feel even for the bigger miners, the current prices like around 160 level is already close to their production cost due to the high royalties. So yeah, like shared earlier, some of the smaller miners may face the pressure to reduce production already. And also for the Q1, we saw less Russian met coal being like released to China or other market as well, with sources also citing the high production cost and running at losses. Yeah, so if the market improve, we may be able to see more supply from this origin as well. Yeah.
Got it. Okay, perfect. Look, we've gone over time by about 5 minutes. I'd like to thank you all for attending and giving us your time today, S&P team. Obviously, your insights are highly valuable for us and our client base. And obviously, given the interest and the questions we had on the webcast, it's fair to say that the clients definitely enjoyed the session, and we'd love to do this again in the near future. So I'd like to thank you all again for your presentation and attendance today. I'd also like to thank the audience for your questions. But this does conclude today's webcast. Thank you all for joining, and we'll catch you next time.